For a long time, gold had always been a symbol of wealth and financial security. For many nations, it serves as a last resort asset, a kind of insurance policy that can be called upon in times of economic distress. In today's global economy, however, many central banks, including that of the Philippines, are actively managing their gold reserves rather than simply holding on to them for safekeeping. Recently, however, the Bangko Sentral ng Pilipinas, BSP, have been making headlines about how they are reducing their gold reserves. Here's a graph on the gold reserves of the Philippines, data from the World Gold Council. Here you can see that there is a substantial decrease in the holdings of gold. In the third quarter of 2023, the Philippines held over 164.77 tons of gold, which at market value was worth over $11 billion. However, by the latest quarter available in the third quarter of 2024, the Philippines' gold reserves decreased to over 128.12 tons of gold, worth just $8.5 billion at market value. This sharp decline of over 36.65 tons raised questions by many and debates amongst the Filipino community. Some think that this is bad for the Philippine economy, whilst others seem to think that it is essential, as the Bangko Sentral ng Pilipinas may have needed some liquidity. To understand whether this is good or not, let us first talk about the role of gold in national reserves. For centuries, gold has been seen as a hedge against economic uncertainty. Historically, under the gold standard, many currencies were directly linked to the value of gold. Although modern economies no longer operate on the gold standard, gold continues to serve as a critical component of national reserves. It acts as a buffer against inflation, currency devaluation, and other financial shocks. In the case of the Philippines, gold has been part of the nation's gross international reserves for decades. These reserves are a mix of foreign currencies, investments, and precious metals like gold. The central bank holds these assets to ensure that the country can meet its international financial obligations, such as paying for imports and servicing foreign debt. If we were to get the data earlier about the Philippine gold reserves and extend the data for many years, we also get to see that there is actually a significant decrease in the holdings of gold reserves, much more than just the past few years. Back in 2020, the Philippines held over 197.93 tons of gold, which was valued at $12.3 billion at the time. This means that in just 4 years, the country's gold reserves have decreased by nearly 70 tons, a decline of about 35%. So, with this decrease in gold reserves, why is the BSP selling them? Well, in today's complex economic landscape, central banks are not simply hoarders of gold. Instead, they actively manage their portfolios to achieve several objectives. The BSP's recent decision to sell gold is a prime example of this active management strategy. According to official statements, the bank took advantage of higher prices in the market to generate additional income without compromising the essential safety and insurance functions of gold reserves. To put this into perspective, let's pull up the graph on the gold price. Here you can see that gold has rapidly increased over the past few years. At one point, it even reached nearly $3,000 per ounce. So if you take a look at it from an investor's perspective, if you had bought this gold in, say, around 2019, where gold was selling for around $1,500, and then you sell it at nearly $3,000 per ounce, you would gain over 100% in profit per ounce. This means that if the Bangko Sentral ng Pilipinas had sold its gold reserves at the right time, it could have generated massive gains. That is why central banks and the BSP are selling gold when the prices are high, so they can capture a profit that adds to the overall strength of the National Reserve portfolio. The income generated from these transactions can then be used to bolster other financial instruments in the portfolio, assets that may provide yields or help stabilize the currency. But of course, the only problem that some may think is that it may just be the Bangko Sentral ng Pilipinas that has been doing this. For instance, neighboring countries like Thailand, which has more gold reserves, have also sold off them, but it isn't at a level that the Philippines did. Likewise, Singapore has also sold a few tons, but still nowhere near as much as the Philippines. So, what makes the Philippines so special? Well, there might not really be any special reason other than the fact that the BSP had taken advantage of the high price of gold. And just because they have sold the gold, it doesn't mean that the Philippine economic stability would go down. When the BSP sells gold, they, of course, would receive US dollars. This would then be registered into the Philippines' gross international reserves, which, as of the time of writing, is about $103 billion as of January 2025. Is this a lot? Yes, indeed it is a lot. For 2024, the international reserves represent a more than adequate external liquidity buffer, equivalent to 7.5 months' worth of imports of goods and payments of services and primary income. What this simply means is that the Philippines has enough reserves to cover its import expenses for 7.5 months without needing additional foreign exchange inflows. This level of reserves provides a cushion against economic shocks, such as sudden capital outflows or fluctuations in global markets. If we compare the Philippines to other countries, we also get to see that the Philippines has much more reserves than many of its regional peers. For example, some Southeast Asian countries have reserves that cover only a few months' worth of imports. This puts the Philippines in a relatively strong position to manage external risks, such as currency depreciation or rising global interest rates. On top of that, it is also reported that the Philippines has 3.8 times the country's short-term external debt based on residual maturity. In other words, the country's reserves are more than enough to cover all short-term external debt obligations nearly 4 times over. This is a strong indicator of financial stability, as it means the Philippines can easily meet its debt payments without relying too much on new borrowings or external assistance. So, despite this good news, why is the Philippines community doubtful about these? One senator even voiced strong criticisms. The senator questioned why the country would sell gold when other nations are actively buying it, suggesting that such a move could be interpreted as a sign of fiscal weakness or mismanagement. Her comments have resonated with some segments of the public and political opposition, who fear that selling gold could undermine the country's economic security. Critics argue that selling a significant portion of gold reserves might signal to the public and investors that the government is in financial trouble. However, several economists have countered this view, pointing out that the sale is part of a routine strategy to optimize reserve assets rather than a desperate measure to cover fiscal shortfalls. In response to the criticism, the BSP and other official agencies have consistently maintained that the sale is part of a well-considered strategy. In press releases and statements, such as those issued by the Philippine News Agency and GMA Integrated News, the central bank emphasized that the sale was executed with the dual objectives of generating additional income and managing risk, not as a sign of economic distress. These statements highlight that the decision to sell gold is not unique to the Philippines. Many central banks around the world periodically adjust their reserve compositions as market conditions change. By following a similar active management strategy, the BSP is aligning itself with global best practices in reserve management. So, do you think that the Philippines' selling of gold is bad? Anyway, do let us know what you think. Thanks for watching.